HMRC is sending out a record number of letters, and many of them are going to normal people like you and me. Small business owners, freelancers earning on the side, or landlords selling a property. HMRC can collect data from digital platforms, banks and government agencies and compare that information against your tax return. If something doesn't line up, you're on their radar. That's why in this video, I'm going to show you what I call the HMRC Trifecta. A simple framework we use with business owners all the time to understand how HMRC may assess risk, why they get in touch, and how to stay protected and prepared. But first, let me show you why this framework is essential to understanding how HMRC works. HMRC risk usually builds in 3 layers. The first layer is third-party data. This is information HMRC may receive or access from outside your tax return. The second layer is mismatches. This is when HMRC compares that outside information against what you declared, your previous returns, your business activity, or what they would normally expect from your type of work. And the third layer is behavior patterns. This is about how you act around the tax system. Do you file on time? Do you respond to letters? Are your records clear? And as you see later, even the accountant or tax advisor you use can become part of the risk picture. And once you see it this way, HMRC inquiries start to feel a lot less random. So let's look at each part of the trifecta properly. The first part of the framework is third-party data, as you already know, and the taxman has a lot more of it than most people realize. This can include information from your bank, your payment processor, digital platforms like eBay and Etsy if you sell something online, trading platforms where you trade shares in crypto, government records like Companies House, DVLA and Land Registry. So when you submit your tax return, you're presenting your side of the story. Think of it like walking into a courtroom and saying, this is what happened. But then the judge starts calling other witnesses. If they all tell the same story, there may be nothing interesting to look at. But imagine one of them gives a slightly different version. Maybe one platform shows sales you forgot to declare, or maybe Airbnb shows income that you thought didn't count, or PayPal shows payments from a side hustle that you never really treated like a business. And suddenly, your story does not sound as clean as it did when you were the only one person speaking. That's because digital platforms in the UK now have to report more information about sellers and their income to HMRC each year. That means if you sell goods and services through certain platforms, HMRC may receive information about you before you have even started thinking about your tax return. And this is not only about online sellers. Banks and building societies already submit certain information to HMRC, and they can use that information for tax calculations and checks on self-assessment returns. If you sell a property, there's property records. If you run a company, there are company house filings. If you employ staff, there are payroll submissions. If you're VAT registered, there are VAT returns. So third-party data sits on top of the trifecta because before HMRC can challenge your story, it often needs another version of the story. And that other version may not come from you. So how do you protect yourself? Well, the point of this video is not to make you paranoid. It's to help you feel more aware and better prepared. If HMRC risk builds from third-party data, mismatches and behavior patterns, then your protection needs to answer those same 3 risks. And this is why I've put together a simple checklist you can use every year when you prepare your tax return. You can download it for free using the link in the description below. And the first thing it helps you do is simple. Know your own data better than HMRC. Because if you want to avoid surprises from third-party data telling a different story than yours, this is what you need to do in practice. Download annual reports from every platform, payment processor, side hustle, investment account, and a rental platform where you received money. Save anything else that could matter, like bank interest summaries, crypto statements, dividend vouchers, rental statements, or any other property documents. Then crucially, compare those reports to the money that actually landed in your bank. This matters because the bank does not always show the full story. A platform might collect 10,000 from customers, deduct 1,000 in fees, and only pay you 9,000. If you only look at the bank deposits, you may miss the full picture. And then if you sold a property, consider where capital gains tax applies. If you took dividends, keep dividend vouchers and minutes. If money came out from savings, loans, gifts, or sale of assets, keep evidence of that too. You find the full list of actions you may need to take in the checklist link below. Because being organized is how you make sure your version of the story matches the evidence already sitting around you. Because once HMRC has the third-party data, the next problem is obvious. What happens if the numbers don't match? And that brings us to the second part of the HMRC trifecta, mismatches. Because getting the data is only the first step. The real power comes from comparing it. Most people think HMRC only looks for obvious errors, like you declared 20,000 but a platform reported 40,000. That is one type of mismatch, but there are others more subtle too. HMRC may look at whether your financial performance makes sense compared with your own history, your business activity, or other businesses in the same industry. Imagine two small companies. One is a construction firm. It has materials, subcontractors, van costs, tools, insurance, fuel, and travel. So if that business has a lower profit margin, that makes sense. But now imagine a freelance consultant working mainly from his laptop at home. No stock, no staff, very little travel, not much equipment. If that person has 80,000 of income, but only 5,000 of profit year after year, that starts to look unusual. Maybe he's doing nothing wrong, but the pattern raises a very good question. Why is this business making so little profit compared to what we would normally expect from this type of work? And that's exactly the point. Sometimes a mismatch is something that doesn't fit a pattern. It's like walking into a wedding and seeing someone wearing a wetsuit. There might be a perfectly good reason. Maybe they came straight from a charity swim, or the wedding was on a beach. But whatever the reason, you're going to notice them, and that is how unusual numbers work. If your business looks very different from what HMRC expects, it may stand out. And this mismatch can often extend into your lifestyle too. If someone reports low income but has large mortgage payments, expensive finance deals, unexplained deposits or property purchases, HMRC may ask where this money coming from. There may be a completely innocent explanation. It could be savings, it could be help from family or inheritance. But if the taxman doesn't have the full picture, your tax return may say one thing while your financial life appears to say another. And this creates another mismatch. So how do you protect yourself from these type of things? The key is to make sure your numbers are explainable before HMRC ever asks. Plenty of genuine businesses have unusual numbers. Low profit might be caused by equipment purchases. High travel costs might come from a new client project. Large bank deposits might be personal savings introduced into the business. Unusual numbers are not automatically wrong. The problem starts when they don't have a clear explanation. So before you submit your tax return, this is what you need to do to protect yourself from mismatches. First, step back and look at the whole picture. If profit is unusually low, write down the reason. If expenses are much higher than last year, keep the evidence. If mileage is high, keep a proper mileage log. If there are large deposits in the bank, know what they are. If you took money from your company, make sure it has been recorded correctly. And if you use accounting software, you can add notes inside the software itself. The point is to capture the explanation while you still remember it. But don't only look at the current year. If this isn't your first submission, compare your performance to last year too. Make sure you can explain why turnover doubled, profit dropped, or expenses jumped. This is how you deal with mismatches if a brown leather lands on your doormat one day. You make sure the numbers support the true story and you can prove it. And again, use the checklist link below. It gives you the extra steps to spot mismatches early and make sure you're protected before HMRC ever gets in touch. But sometimes the thing that makes HMRC look closer is not third-party data or even the mismatches itself. It's the way you behave around the tax system. And this is why the third part of the HMRC trifecta is behavior patterns. This is where a lot of people get caught out because they think tax risk is only about numbers. But numbers are only one part of the picture. Two people can make the same mistake and look completely different. Imagine two business owners. Both forget to declare £3,000 of income. The first one files on time every year, keeps decent records, replies to HMRC quickly, explains where the mistake came from, and corrects it properly. The second one files late, ignores the first letter, sends random screenshots, changes the explanation twice, and then tries to fix it quietly in the next tax return. Same mistake, completely different risk profile. The way you behave can send a stronger signal than any single number on your tax return. If HMRC sends a letter and you ignore it, that sends a signal. If your tax returns are regularly late, that suggests poor record keeping. If every question you answer creates 3 more questions, HMRC is no longer looking at an isolated mistake. And that matters because HMRC does not know you personally. They don't know that you were busy, stressed, overwhelmed, dealing with clients, chasing invoices, trying to run a business, and opening HMRC letter with the same enthusiasm most people reserve for dental appointments. What they see is the behavior. A late return, a missed payment, a vague explanation, a missing receipt. And it's not only about your behavior that can affect how risky you look. It can also be the behavior of the accountant or tax advisor submitting returns on your behalf. And this is where some business owners make a dangerous assumption. They think, my accountant filed it, so is there a problem? But the tax return is still yours. You're ultimately responsible for it. A good accountant helps you claim what you're entitled to and keeps the evidence clean. A reckless accountant pushes every deduction to the edge, submits weak claims, and uses the same aggressive approach across lots of clients. You may think they're saving you money, but HMRC sees an agent whose clients often have unusually high expense claims, repeated refund patterns, and poor quality returns. That's why a good accountant should not just reduce your tax bill, they should eliminate the chance that your tax bill becomes a problem. So how do you protect yourself from behavior patterns? Well, you act like someone who takes tax seriously. And that all starts with deadlines. Put every tax deadline into your calendar at the start of the year. Self-assessment, VAT, corporation tax, confirmation statements. Then set reminders well before the deadline, not on the deadline itself, because finding out your VAT return is due today at 9 p.m. is not a good plan. And if you can't pay a tax bill, don't just disappear, speak to HMRC, agree a plan where possible, and keep communications clear. What you need to do next is open HMRC letters as soon as they arrive. I know the natural instinct is to leave them on the kitchen table and hope they somehow become less serious, but if the letter needs your attention, the worst thing you can do is ignore it. And when HMRC asks a question, answer that question. Do not send a messy folder of random documents unless you understand what they're asking for. A good response should reduce questions, not create 5 new ones. And if you find a mistake, don't just bury it in the next return and hope the old year gets forgotten. If the mistake belongs to a previous year, correct that year properly. And when it comes to your accountant, choose carefully. Don't judge them only by how low they can make your tax bill or how much they charge. Look at how they explain risky claims, check whether they ask for evidence, notice whether they challenge weak expenses, and pay attention to whether they give you copies of what they submit. So this is the full HMRC trifecta. And the best way to protect yourself is to use a simple checklist when you prepare your tax return. The one in the description below is designed to help you check the 3 areas we covered today. What data exists, what might not match, and what behavior could make you look risky. Download it for free, save it somewhere useful, and use it every time you prepare your tax return. So now you know how HMRC builds your risk profile. But if you run a limited company, the next problem is not just staying compliant. It's taking money out of the business properly without creating a tax mess. So watch this video next, where I show you 31 legal ways to extract value from your limited company without relying only on salary and dividend.